Amazon just announced they beat on revenue, greatly missed on EPS, but the stock is up a ton after hours. So let's look at the stock real quick before, let's go to Amazon on our Everything Money software. You can get it. Oh, so it's up 11% right now. All right, so this is their press release. Operating cash flow decreased 40%. Free cash flow became an outflow of $23.5 billion compared to an inflow of $12 billion. That's pretty significant. That's a pretty big drop. Sales right here increased 7% to 121.2. They were expected to do 119.2. They did 121.2. They're expected to earn 12 cents a share. They actually lost 20 cents per share. Why is the stock up 10%, 11% after hours? I don't have a clue. They beat on revenue. That's awesome. That's great. Let's go see what else we can look at here. Operating income decreased to $3.3 billion compared to $7.7 billion in Q2 last year. Common shares outstanding are even up. Okay, so Amazon had a good revenue number and a bad earnings number, EPS number. Got it. Now let's go look at this. If you're new to this channel, I'm Paul. I'm a value investor. My job is to look at a company and a stock is totally different things. I can love the company, hate the stock. That is my goal here, to teach that process. If you're new to this, I understand that. I can't explain everything that happens, but we look at Amazon here. This is their 1-year chart. Remember, they split 20 for 1, and they had a high of 188 and a low of 101. And currently after hours, they are at 136. So they're well off their low. They're 36% off their low that they hit back in June, which is a pretty big jump. Let's look at their 8 pillars. This 8 pillars is our way of looking at a stock to screen a stock to decide what to do next. There's a lot of X's here. Now remember, people are mentioning me in the chat. That does not mean that because there's a lot of X's here, you should ignore the company. But let's look at the big ones here. The 5-year PE and the 5-year price to free cash flow are ginormous. Now remember, guys, here's why I think this is bad. A higher PE and a higher multiple for free cash flow is justified by the fact that the company has a lot of growth potential. The company already does $500 billion a year in revenue. How much faster can it grow? How fast can a $500 billion a year revenue business grow? If they grow 10% a year, they're going to be doing $1.5 billion in 10 years. $1.5 trillion. I'm sorry. That's a big difference. Shares outstanding are bad, but the long-term liabilities, 16 times their free cash flow for their long-term liabilities, that's a tough one for me. Their 5-year average free cash flow is $8.5 billion, but that does include a loss of $24 billion in the last 12 months. But according to this, $284 billion increase in revenue, $17.5 billion increase in net income in the last 5 years, but a $30 billion decrease in free cash flow. Let's go look at that free cash flow real quick, because there is a story to the free cash flow. Now it's up 12.5%. So remember, free cash flow is cash from operations less your capital expenditures. That's the key here. Look at these capital expenditures. 9, 13, 13, 20, 45, 64. They're spending a ton of money in capital expenditures. Look at their cash from operations. 17, 18, 34, 39, 67, 39. So the cash from operations is definitely increasing, and they've been investing a lot back in the business, and that's why their capital expenditures are so high, and that's why their free cash flow is low. Do not punish Amazon for this necessarily. Go do your research on what they're spending $108 billion in the last 2 years on. That's very important to look what they project for the future and how they're going to grow in the future. Now, one thing I do want to remind you, I don't know if it's still the case now, but last quarter, 100% of their profit came from Amazon Web Services. They do not make money on the stores yet, but they are big. They're big on growing their advertising base of their company. So that's one thing I want to look at also. Let's see if it says right here. AWS, big numbers in AWS. Let's go. So I'm just looking at the report, and I'm just going to look to see where revenue and income might be split up here on AWS. So there we go. Ready? AWS net sales, 2021 to 2022, 14.8 to 19.7 with operating income of 4.1. Look at consolidated takeout operating income or loss from their North American and international loss. They lost money on those. For the 6 month ended, lost even more money. They lose money selling product, but they do it to keep people at Amazon. And it's great because guess what? When you want something, what do? You order it. Yesterday, a friend of mine told me it was her birthday. I said, great, I'm going to send you a gift. I literally shipped her an air fryer. And she just got it 30 minutes ago, texted me, said, this is awesome. I already have an air fryer. I went on Amazon.com. I clicked out the return label and emailed it to her. Boom. She's going to have a new gift whenever she wants for 99 bucks. That's awesome for her. That's what's so great about Amazon. How they convert that into more dollars. AWS is not because of you and me, though. AWS is a lot of big companies and companies that use their services. So what to do about Amazon? Go look and see if they're going to figure out a way to really increase its operating income for their shipping. They really need to do that. I don't know why they swung from a gain to such a big loss, but the point is it shows that they can make a lot of money. Oh, I know what it was. It was COVID. When COVID shutdown happened, look at that. And by the way, COVID caused us to go from 11% of all retail sales being online to 16%, and Amazon owned half of that. Now it's decreasing again, back to more normal levels of people going back to the stores. So these are all the things to sit there and consider when looking at Amazon. I like the fact they've driven down their revenue and profit, but let's go use our stock analyzer tool to determine what to pay for this company. So if you know this, if you watch this channel, you know that I will always say, every investment's the present value of all future cash flow, but we don't know the future. Our goal is to make assumptions about the future and input it into stock analyzer tool, our revenue growth, profit margin, free cash flow, blah, blah, blah. It'll tell us what to pay for Amazon based on those numbers. It doesn't consider the balance sheet yet. So let's go make these assumptions. First off, I'm doing a 10-year analysis. You can do 1 to 20 years. Now for revenue growth, guys, it's not going to grow 25% a year for the next 10 years. And I'll show you why. 25% a year for 10 years would take their revenue to $4.6 trillion. No company in the world even does $1 trillion today. I have a hard time believing that in 10 years, Amazon will be doing $4.6 trillion. Is it possible? Sure. Is it probable? Not very likely. So I'm going to go lower. I'm going to do 6, 9, and 12%. Profit margin. I'm going to do 4, 4.5, and 5. Free cash flow margin. I'm going to do 3, 4, and 5. PE. 15, 18, 21. And you might be whining going, oh my God, Paul, that's terrible. I get it. But guess what? The average company over long periods of time is 15 PE. I'm going to assign that to Amazon at the very low level because they will have a huge moat. And I'll give a little premium to it along the way. 12.5% return. The stock is currently $137 per share. Now, I hit the analyze button. It's going to spit out 6 numbers for me. 3 prices, low, middle, and high based on earnings. 3 prices, low, middle, and high based on free cash flow. If they're all green, don't go running out to buy. Go verify that your assumptions are correct and you like the qualitative aspects of the business. If they're all red, doesn't mean you necessarily avoid. If they're close to the number, do more research. So you're ready to buy when it gets added to your watch list. The second it hits, you're ready to buy. So I hit the analyze button. Okay, what I expected. It's got a long way to go. Now, guys, the low end is 20 to 30, high end is 70. Middle range is around 40. And you might sit there and say, geez, there's no way that's going to happen. I know. It seems that way. But just remember all the stocks that have fallen 80, 90% in the last year. Look at all the major hype stocks. Even Amazon was at one point down how much? Amazon hit a high this year of 188 and a low of 101. That's almost a 50% drop. So don't say it's not possible. Just be ready. I'm going to put my watch for $70 a share, notify me when it goes below. And I'm going to sit there. I'm going to get an email. I'm going to get a message on our software and a message on our app. If you like the software, check out everythingmoney.com to learn more about it. It's less than a cup of coffee per day. Thousands and thousands of people actively talking in this community. I'm sure they're talking about Amazon now. They're talking about Intel because Intel's reported it was terrible. Roku reported it was terrible. So if you like this, please check out our next video. Please subscribe to our channel and check out our next video. 8 pillars, how to understand them and do better with them. Thank you very much for your time.